Good day, and welcome to the DoubleLine Income Fund Webcast. As a reminder, today's conference is being recorded. At this time, I would like to turn the conference over to Ron Riddell, President of DoubleLine. Please go ahead, sir.
Well, thank you, and good afternoon, and welcome to the DoubleLine Income Fund Webcast with Ken Shinoda and Morris Chen. Please mark your calendar for the most anticipated webcast of the new year with Jeffrey Gundlach on January 10th, titled Just Markets, where we're just focused on the markets, no product discussions at all. It is our most participated webcast of each year. Also, on February 7th, we'll have a diversified fixed income webcast with various portfolio managers of many of our multi-sector fixed income strategies. If you'd like to see the 2023 webcast schedule, it is up on our website now at doubleline.com. If you want to receive a copy of today's presentation slides, you can go to the webcast player and request webcast content tab. Please follow us on our Twitter handle, DLine Funds, and we do have a couple of YouTube pages, DoubleLine Funds and DoubleLine. Also want to highlight some thought leadership coming up on actually January 4th. We have this every year. It's the DoubleLine Roundtable Prime. It features many of the financial thought leaders, Jim Bianco, Daniel DiMartino Booth, Jeffrey Gundlach, and this year, Charles Payne and David Rosenberg. It will be moderated by our very own Deputy CIO, Jeffrey Sherman. Also, Ken Shinoda, here today on this webcast, hosts the Channel 11, and you can email channel11@doubleline.com. We also have two podcasts, the Sherman Show podcast, the very popular Sherman Show podcast, and Monday Morning Minutes with Sam Lau and Jeff Mayberry. You can listen to those at doubleline.com, iTunes, SoundCloud, Google Podcasts, Spotify, and Stitcher. Today, both portfolio managers will be discussing the DoubleLine Income Fund, and here you can see the different expense ratios and minimums for our open-ended mutual fund. The standardized performance in the DoubleLine Income Fund, it was launched not too long ago, September 3rd, 2019 through 11/30 of this year, minus 4.02 versus the Bloomberg US Ag at minus 2.54. There will be some discussion and comparison with our DoubleLine Total Return Bond Fund, so we wanted to show you that standardized performance as well. And again, that fund was our first fund launched on 4/6 of 2010 and through November of this year, an annualized return of 3.76% versus the Bloomberg US Ag at 2.22. So I would like to wish everyone a happy holiday, and
All right. Thanks, Ron. Appreciate the intro. All right. Well, we're going to take a look at some market slides, and we'll dig into the portfolio and see how it's positioned. So first off, for those that may be new listeners and new to the income fund or interested in the income fund and not invested yet, we just wanted to take a brief moment to talk about why it's interesting for your portfolios. It's a diversified source of income, getting yield from the securitized markets, mainly securitized credit, things like non-government guaranteed mortgages, commercial mortgage-backed securities, asset-backed securities, collateralized loan obligations, and some agency mortgages, as opposed to going into corporate credit, things like investment grade, high yield, and bank loans. So we're just getting our returns from a different pocket of the market. These assets in the securitized credit markets do tend to have lower interest rate risk. And we've seen that this year. It's been more of a story of a spread widening in the securitized markets as opposed to price declines related to rates. Obviously, rates have some component of price declines this year. And we'll take a look at that. And as we see, the spreads on securitized assets are some of the widest levels relative to corporates that we've seen over the last 10 years. The portfolio can be complementary to a traditional core type fund or core plus type fund. This is definitely adding credit to a portfolio, getting paid a nice yield for that. So today you can see that the SEC yield of the portfolio has gone up with this rise in rates and widening in spreads to 9%. We're still carrying very little interest rate risk, and about 38% of the assets in the income fund are floating rate, and that's why our duration is on the lower end of the spectrum. Many of you may be in our total return bond fund, and we wanted to just take a moment to compare and contrast The total return bond fund is more of a core plus type fund. It's always going to have a high percentage of government or government guaranteed type bonds like agency mortgage-backed securities. You can see in this chart that 53% of the total return bond fund is in some combination of treasuries and government guaranteed mortgages. We have about 14% in agencies and treasuries and about 12% in cash. Cash obviously yields something today, so it's not yielding zero. There's actually very high yields on cash. So we have about a quarter of the portfolio in kind of government guaranteed and or cash liquidity type assets. So we'll always have more credit risk. Our credit exposure is about 3/4 of the portfolio, whereas the total return bond fund is less than half. And our credit typically will have a little bit more risk. You can see our investment grade percentage is 47% of the portfolio, whereas the total return bond fund, 75% is investment grade. And what's not investment grade in the total return bond fund are some mortgage related assets that don't have ratings. Doesn't necessarily mean they're below investment grade. So think more credit, a slightly riskier credit than what we would own the total return bond fund. And that's, of course, why we have the higher yield of 9% on the portfolio today. This is a great cartoon that I found. And when we started putting this slide presentation together, the market had just started the euphoric rally in equities that we've seen and the tightening of credit spreads. But at that time, about a month or so ago, when we started putting this deck together, the market was really hoping for a Fed pivot. And so here you have two stranded investors on a desert island. I guess it's not a desert island, there's a tree there. But they're really hoping not to be saved by a boat. They really want the Fed to pivot so their assets can go back up in price. And so that's kind of what the market's pricing in currently, is that the Fed is closer to the end than the beginning in their fight against inflation, and that eventually short-term rates may fall again. And you've seen that recently in the price action of the short end of the Treasury yield curve, with rates seemingly having potentially peaked on the year and have started their decline as the market starts hoping for that the end is in sight, if you will. So we'll go through some market slides. This is the return of the index through time. And this is a great slide to show any of your clients that are scared about bonds because they've had negative returns this year. This is, in fact, if this year ends negative, and I'm going to go out on a limb and say I'm pretty sure we're going to end the year negative on the bond index return, that this will be the first back-to-back negative years going back to 1978. And that's when we started recording, I think, daily data for the index. And the years where you see these gray bars going up, those are whenever the bar is gray, those are years that the 10-year Treasury yield went up on the year. And what's interesting about this is there's many years where the return is positive with rates going up. In fact, the dots are the drawdown, the peak drawdown on the year. And there's many years where there's a pretty significant drawdown of 4 or 5%, and you still end the year positive. And that's because if you have enough yield to start the year, you can see the rates rise, let's say in the first quarter. You haven't earned much coupon yet, and then you earn your coupon through the end of the year, and you end the year positive, getting that total return through the carry. That didn't exist about a year or so ago because yields were so low. But now that yields have risen pretty dramatically, the income portfolio having a yield of 9, there is now a lot of cushion to either rates moving higher and or spreads widening. So having a higher yield really can help cushion total returns. This is a chart of the yield of just the index. Got to a miserable 1% in 2020, got as high as low 5s about a month and a half ago, and now we're sitting around 450. And in the upper right-hand corner just shows you a simple analysis of take the duration of the index, move the yield up and down 100 basis points. What's your return? The downside scenario is much lower now because you have that yield. So, could rates keep rising? Sure. Could spreads widen a little bit? Of course. Could they widen a lot? Absolutely. But when you have a starting yield of, in this case, 4.5% for the index and 9% for the income fund, you have a lot of room to have some vol in rates and vol in spreads and still end the year with a solid return profile. As we look year to date now, this is through December 9th, we're off the lows. At one point, investment grade bonds were down almost 20%. EM was down over 20%. And we've had a little bit of a rally here. But you can see that the things that got hit the hardest were longer duration assets, investment grade corporate bonds, treasuries, agency mortgages, global sovereigns. The best performing assets have been floating rate assets. So kind of towards the right, you can see double B CLOs actually positive 2.3% return. So floating rate assets have held up well. CLO AAAs also slightly positive. Triple B CLOs only down 3.8%. What I'll point you to is the securitized credit assets. Those are in the beige. And you can see that as a basket, they've done better than most everything except bank loans. What I'll note is that this is due to the shortness of the assets, either their floating rate or the structure of the deals make it so that the bonds just have a shorter weighted average life. And what that does is for equal movements in rates and or spreads, the bonds go down less in price. They've actually underperformed from an excess spread standpoint, meaning if you took duration out, spreads are actually widen more on securitized assets relative to corporates, even though they've performed better from a total return standpoint, meaning that there's a relative value play now in the securitized markets relative to corporate credit. And we'll get to some slides that show that. This is the Treasury yield curve, the 2-year, the 5-year, the 10-year, and the 30-year. It is quite possible that we have seen the highs in yields, especially on the longer end of the yield curve, 10s, 30s. We got to about 430 intraday on the 10-year, and we're down to 350 today after this the second soft CPI print that we've seen, softer than expected. And so there's a chance that rates could back up again. We'll see what happens with the Fed tomorrow. But I do think that there's pretty good support at or around 4%. And we talked about that, I think, on our last webcast too. And so let's talk about kind of worst case scenarios and how things could play out for those that may still be negative on long-term rates. This shows you the 2-year, which is in the blue, and Fed funds, which is the I guess it's a brown color, and it's the escalator up, and then it's the elevator down, or the stairs up and the elevator down. You can see that towards the end of the hiking cycle, what happens is that the bond market starts pricing in the end, and that, in fact, the Fed will have to cut at some point in time. So you start seeing an inversion in Fed funds to the 2-year. I mean, I think some of the most hawkish economists out there are forecasting, we have to get to like 5.5%, 6% Fed funds for the Fed to, accomplish your goals. And we're not as negative on Fed funds at DoubleLine. We think that the market's roughly pricing in an accurate estimation that we get to something around 5%. We may not even get to 5%. But let's just say they do get to 6%. That's pretty extreme. And you see towards the end of the cycles, the beige kind of chart at the bottom underneath these lines shows you the inversion of the yield curve between Fed funds and the 2-year. And it kind of gets to like 100 plus basis points inversion. We're still positively sloped right now. This is going to drop tomorrow after the Fed moves probably 50. But you can see a scenario where Fed funds gets to 6%, but the 2-year does not get anywhere close to it. The 2-year starts inverting the Fed funds. Maybe it gets to, high 4s. We got to, 470-ish. So in a worst case scenario, maybe you say the 2-year would get to 5. I don't think that's going to happen, but let's just say that happens. You'd probably have a pretty deep inversion 2s to 10s. In fact, we got to about almost 80 basis points, and it's quite possible we could go to about 100 basis point inversion, if not more, 2s, 10s. So kind of the worst case scenario that I've been playing out for investors that are still scared about rising rates, perhaps on the short end, but you could get Fed funds goes to 6, 2-year is inverted out to that about 100 basis points. And if you get to 100 basis point inversion, twos, tens. That puts a pretty solid ceiling on the 10-year around 4.25 where we were. So I think a lot of people wish they had bought there, which probably means we may not get all the way back up to that 4.25. So I think if we do get it back up here in long-term rates, it's a pretty decent buying opportunity. I mean, compared to where we were a year ago, even 350 could be a decent buying opportunity, but it's hard when you've seen such a violent move down in long-term rates. So kind of got to try to look at big picture asset allocation and say, yeah, maybe I missed that 4.25, but the big scheme of things, we were at 1% not so long ago. So when we were at 1%, I probably wish I could buy at 350, and here we are. So think about that in your asset allocation. This shows you yields across the landscape. In the left-hand side, in the beige, is the index type assets, treasuries, agency mortgages, investment-grade corporate bonds. And you can see the yields have, in some instances, almost quadrupled year over year. Agency mortgages yielded 1.2 a year ago. If you go to the summer of last year, was the all-in lows in yields, and yields were sub 1% on some pockets of the agency market. And now you can buy some agency bonds. At one point at the end of October, we were over 5% yield for many of these assets. IG corporates got almost to 6%. And then on the right-hand side in the blue, those are the non-traditional assets that many managers go into to pick up yield over the index, things like high yield, bank loans, emerging markets. And then on the far right-hand side, the pockets of the securitized market. You can see everywhere yields have almost doubled in many places. On the far right, I put double B CLOs. We own some of those in the income fund. And those now with the index, their floating rate, with SOFR headed towards 4.5 after tomorrow, and spreads widening, you can get teens type returns, double the long run return of the global equity at 13.6% return, with a lot of safety in the credit. The capital structure gives you a lot of safety. Morris is going to run through some scenario analysis to show you that. Doesn't mean there can't be price volatility, but holding these assets to maturity, we think many of our assets will not be taking losses. This has been really a story of just rates rising, spreads widening, price declines. We haven't seen the default cycle come through the corporate credit market. We haven't seen much rise in delinquencies in the securitized markets yet. Obviously could happen if the economy keeps slowing down. So not only are yields up a lot, that means that prices are down, which means that there's tons of price upside now. There's tons of convexity. The problem with the bond market, generally speaking, in normal times, is that bonds are issued at around par, maybe a slight premium, rates rally a little bit, spreads tighten, all of a sudden everything is at a premium. So just look, using agency mortgages as an example, you buy something at 103. I mean, it's hopeless. You're gonna get par back one day. It's just a matter of when are you going to get par back, because your coupon could be higher than your yield, which is why you're at a premium. But you're going to slowly come down towards par through time. Now everything in the bond market, almost everything, is at a discount. In the end of October, these dollar prices were all in the mid 80s. We've had a little bit of a rally since then, but still $90 price where we were at 103. So the problem with most pockets of securitized is often that negative convexity, the fact that the callability of the assets or the structures make it so that the bonds can't go up much above 103, 104, 105. Some pockets can, like CMBS, more bullet maturity, but a lot of assets are more callable. And so you often see a certain level of prices when we get there and we can't go much higher in price. Well, when you're at 90, there's plenty of upside. And we see that across the spectrum of the entire bond market. In fact, agency mortgages have some of the best convexity that we've seen in decades. We'll look at that in a second. Okay, so what looks cheap right now? On the top is a decade-long candlebar chart of the range of yields in the black candlebar, and the triangle is the yields today. The square is the average yield over the last 10 years, arguably skewed down perhaps by quantitative easing. And you can see that we're close to the highs in many of the sectors. As you go to the credit sectors, everything kind of gets skewed by March of 2020. Like high yield, for example, which is fifth from the left, it got to 1,000, 1,100 over for like 2 days. And so, yeah, it got to 12 yield, but it wasn't really there for that long. You couldn't buy a lot of it. So another way to look at cheapness is looking at a percentile rank of spread through time. So in the table below, these are all these different indices that we've been looking at. The only thing I'm missing, there's not a good non-agency RMBS index, so non-government guaranteed mortgages. There's not a good index, so that's the only reason I don't have that on here. But it would be similar from a percentile ranking. Most of the securitized markets are greater than 90th percentile. So for example, 98th percentile on agency mortgages, second to the left, means that there's only been 2% of the days over the last 10 years where spreads have been wider than they are today. And you can see on the securitized markets also 92, 93 percentile for these markets. Even bank loans screens, not screams, but screens cheap from the standpoint. The only thing I'd be wary of on floating rate debt in general is that they do great into the rate rise, but once short-term rates are higher, LIBOR, now SOFR, the cost of debt for whoever is borrowing at the floating rate has gone up a lot. So you can see the average spread on bank loans is about 500. If Fed funds futures is right, we're going to get SOFR up towards 5%, which means that the cost of debt for some of these borrowers has doubled. And if we pause and we don't cut short-term rates, these people that were borrowing at 5% are now borrowing at 10%, potentially into an economic slowdown. So that's something to be wary of. Yes, it's screening cheap. Maybe it's screening cheap for a reason. So just something to think about. And we think bank loans, we were very bullish on bank loans entering the year, but they could still do okay. Obviously, it's a credit selectors market. Pick the good companies, pick the good bonds. Same thing in the securitized space, but just something to think about with floating coupons on the rise in some countries that don't have 30-year fixed rate mortgages, that are more focused on adjustable rate mortgages like the UK. You're already seeing defaults rise on mortgage related assets. In the US, we're lucky we've got the 30-year fixed rate mortgage. And that has actually, I think, going to help a lot of borrowers, given most people are in really low coupon mortgages. Okay, so one of the questions I get asked often is like, okay, well, I think we'll go into a recession. What's my downside? I don't have good indices for securitized going back 30 years because a lot of these asset classes did not exist 30 years ago. So the best thing we can do is look at the corporate credit markets spread history as a barometer of what the downside is. On the far left-hand side is the investment-grade corporate bond market. I kind of feel like you have to throw out the GFC because I don't think that was normal. I also don't think March of 2020 was normal. There's a lot of things that caused the extreme volatility over those couple of weeks. Basically, everyone was had evacuated offices and gone to their kitchens, working as trading desks, working from their kitchens. And if you're a risk manager, you tell people don't buy anything if they're not all in your office and they're trading, with a cell phone in their underwear at the kitchen table. So I think you throw those two things out and then you look at the history of spreads. You can see that IG gets to about 250 during recessionary periods or weak periods of growth, right? So that's kind of your downside on IG. IG is in the low 100s now. So it's got 100 plus basis points of downside. Could end up okay on a total return standpoint. This is something to think about generally for all bonds. You figure IG spreads widen 100 basis points. Rates are probably down 100 basis points in that economic scenario where spreads are widening. So you could be a wash from a price standpoint. Rates rise 100 or spreads rise 100, rates fall 100, you earn your coupon, you end up with a low single digit type return. You basically earn your yield. Maybe spreads widen a little bit more than rates fall, so you end up with a flat total return. But that's why a lot of people say, higher quality credit can, do okay in that recessionary environment. It's because usually there's some duration associated with it, or spread widening is less severe than you will experience in down in credit, and that can help, help you make it through that spread widening period. But 250 on IG, just keep that in the back of your mind as far as like the downside. Then you look at high yield. High yield gets to about 800, 900. It obviously got to almost 2,000 in the GFC, and it got to 1,100 during COVID. But historically, going back through time, you see that it gets kind of like to 800, 900. On a percentile rank basis, even excluding GFC, both IG and high yield after the recent rally look really expensive. They're like, going through time, they're like 50th percentile over the last 10 years. We saw earlier, they're low 60th percentile. Bank loans looks a little bit better. I think you have to throw out before the global financial crisis, spreads were really low because of the CLO, ABCP, Civ machines that were out there. So I think post GFC is a more normalized spread to look at. And post GFC, as we saw earlier, bank loans do look cheap on a percentile ranking basis, but maybe they're cheap for a reason. And I think people should be wary of an increased default risk in floating rate assets broadly. Okay, so securitized. These are the 4 pockets of securitized that we traffic in the income fund. Top left, RMBS, residential mortgage-backed securities, non-government guaranteed. Top right, commercial mortgage-backed securities. These are conduit bonds, which are 10-year fixed rate, backed by a mix of loans in the commercial market. Bottom left, this is just a generic auto loan transaction. And bottom right, CLO, floating rate, backed by floating rate bank loans. These are all floating rate. So we talked about 250 spread on IG. There's 250 spread available now, if not higher, in many pockets of the investment grade market in the securitized space. In fact, the bottom of the investment grade universe in the securitized spread space, in some pockets like RMBS, CMBS, and CLOs right now, ABS is seeing a little bit of a rally here in the triple Bs. Their spread is wider than that of the high yield market for investment grade bonds in the securitized space. And as we go down to the double Bs, we've got bonds already 800, 900 spread in CMBS and in CLOs. So it doesn't mean that the spreads can't widen more if risk markets reverse, but corporates have rallied a lot, and securitized, it tends to lag. It tends to lag both on the way down and also on the way up. It has to do with the fact that there's a lot of idiosyncratic aspects of deals, different issuers, different collateral. You could, CMBS, each deal could be a different property. And so the market is not as homogenous, so it doesn't rally all together. It takes time for, bonds to trade and that pricing to get spread through the marketplace in some ways. So it's just kind of how the structure is. And what that does is it lags on the way down, it lags on the way up. We saw this during the post-COVID sell-off in March of 2020. So spreads have tightened a lot on corporates. Spreads have not come in on securitized. They are starting to as the equity market continues to get bid, but they're very cheap on a historical basis relative to corporates, also relative to their own history, right? Also relative to all-in historical yields. We're at very high levels of absolute yield. So on the top, you see AAA CMBS and AAA CLOs. We don't really own these in the income fund. We do own those types of assets until return. And you can see that the spread on these assets is the widest it's been to corporates in the last decade. So when the blue line is above the dotted line, securitized is cheaper to IG. When the line is below the dotted line, securitized, IG is cheaper securitized. And the IG index is a weighted average rating of, I think, like A-. And these are AAAs. So there were periods of time through the mid-2010s where the spread on AAA CMBS and AAA CLOs were inside of IG because they're AAA. There's only 2 AAA corporate companies. It's Microsoft and Johnson & Johnson. Everyone else has borrowed a ton of money and doesn't get a AAA rating anymore. So the high grade part of the securitized market looks super cheap to the investment grade market. And then the bottom of the investment grade, not even high yield pockets of securitized, the triple B components of CMBS and CLOs. And the reason I picked these and not ABS and RMBS is these are 2 more homogeneous benchmark type indices. So it's easier to compare. But we saw on the other page that spreads in RMBS are wider than both CLOs and CMBS in some instances. But look at that. The spread relative to high yield is the widest that it's been in almost a decade for CLOs, and almost as wide. The widest has been, there was March of 2020 that skews CMBS because obviously there was a lot of concern around commercial assets during that time period. So both securitized looks very cheap relative to its own history. It also looks cheap relative to corporates. And I think there's a great opportunity right now on a relative value play, securitized versus corporates. We don't own a lot of agency mortgages in the income fund as we're focused on generating a higher income. But I'll just note that we've had a little bit of a rally here. This is on the left-hand side is the nominal spread of current coupon MBS. That's the bond that's trading closest to par or close to par. And you can see it got to, about a month or so ago, the widest levels that we've seen in a long time. And at that point in time, I could say basically it's the widest level since the global financial crisis when we thought Fannie and Freddie were going under. We then put them into conservatorship, and then you got a blink of an eye in March of 2020 before we stepped in. The Fed stepped in with the $500 billion agency buy program that turned into the infinite agency buy program by the end of that week. And we've rallied since along with the rest of the spread markets, but we're still pretty wide relative to history and especially relative to corporates. The other thing is that you can go back to the mid 80s, the average spread through time, nominal spread, current coupon has been around where we are today, about 130, 135. The thing is that the risk is much lower now. The risk in mortgages is negative convexity, right? Both if rates fall, everyone refis, your bond doesn't go up in price relative to treasuries. If rates rise, nobody refis, your bond extends, it rolls up the curve in a steep curve environment. And so now, 30 days ago, there was actually the first time in my career that the agency mortgage market had a positive convexity. I started in the business in the early 2000s. And that's because we sat at such a low rate environment for such a long time that most people that bought a house or refinanced got into something like a 3.5% mortgage. And then rates rose dramatically from that standpoint. So most mortgage bonds, the assumption is that most of the people cannot refi, and that even if rates fall, so much of the mortgage universe is in such a low coupon, rates could fall 100 basis points, and something, at least when the 10-year was at 4%, something like 99% of the mortgage universe could not refi for the first 100 basis points. So you just have a really good convexity profile, and part of this also has to do with the fact that these bonds are now all at such lower dollar prices. So while the spread isn't at the widest it's been ever, it's still very wide relative to history and especially wide relative to corporates. This is a theme that I'll just keep pounding the table on, is the relative value to corporates. This shows you the IG market less the MBS market. And when this line is, in this instance, below the dark bold dotted line, MBS is cheaper. And forever and ever, corporates were cheaper because of QE was suppressing spreads on mortgage bonds. And now that we've come out of that and spreads have widened, we're very cheap relative to corporates. I see back in the early 2000s, you were at higher levels of cheapness on a spread basis, but the risk was higher. Rates were on mortgages were much higher. And so there was a much higher amount of negative convexity or risk in the mortgage market. You can see here, the negative convexity on average has been about negative 1.5 for mortgages. And here we're not quite positively convex anymore. We're the least negatively convex that we've been in a very, very long time. So securitized products look very cheap relative to corps, both IG and high yield, and also the agency market. We don't own too many agency mortgages in the income fund, but we have a bunch of them in other strategies like our total return fund. And there's other ways to get access to that opportunity set out there. Okay, so I'm going to turn it over to my colleague and co-portfolio manager, Morris Chen, to take a deeper dive into the portfolio.
Okay, thanks, Ken. Hello, everyone. As we're looking at our portfolio at this juncture, I want to focus on, Ken had touched upon, the relative value in terms of securitized products relative to corporates. And as we're thinking about, yield in this environment, specific to this fund from a strategy perspective. We want to deliver yield. The yield on this fund is currently at 9%, function of some spread widening on a year-to-date basis, as well as some move in rates. Thinking about the portfolio from a asset allocation perspective, we do have exposure across RMBS, CMBS, CLOs, ABS, and some agency mortgage-backed securities. There is plenty full of diversification. As we're thinking about credit risks, this is an environment where we want to it's a security selection bias type of investing environment, and as such, we've put together a portfolio that is going to be resilient in a variety of economic conditions. And as we're thinking about rating and risk rating wise, I would point out that close to half the portfolio is in investment grade rating. Thinking about the resiliency in terms of the portfolio, this is one way to look at the benefits of structured products. Structured products are set up in terms of providing a capital structure which can insulate investors from potential losses, depending on which tranche one decides to invest in. Within our existing holdings, as we're thinking about the residential sector or the commercial sector or CLOs or ABS, on the blue bars, you're seeing credit enhancement, this is the protection in terms of principal protection that an investor would have before you see a first dollar loss. So on the residential side of the markets, in terms of holdings, we have about 18% in credit enhancement, meaning the trust can suffer up to 18% loss prior to a first dollar principal loss within our existing holdings. So a lot of cushion from potential defaults and/or losses. And also keep in mind the dollar prices, just given the year-to-date moves in terms of spreads. As Ken touched upon, there is convexity in the form of positive convex bond profiles, and within our portfolio, you're definitely seeing, because of the discount dollar prices, that also adds to that convexity profile. So within CMBS, we have 7% subordination. Within CLOs, we have 9% subordination, and within ABS, we have 15% subordination. So definitely, bonds are structured with appropriate protection from potential defaults and headwinds that the economic conditions can throw at us. And diving into the individual sectors, we're looking at the resiliency in terms of setup of our portfolio along that theme. Within the residential space, our average LTV is at 62%. So that implies there's 38% of homeowner equity that is subordinate to us within our residential portfolio. So definitely a lot of equity in play viewpoint in terms of residential. And along the similar themes within the commercial mortgage-backed securities arena in terms of commercial real estate, here again, thinking about our exposures, we have average LTVs of about 68%. To the bonds that we own, the LTVs are at 62%. And then on top of that, what is subordinate to us, we have about a 9% subordination. So meaning, bonds, meaning there's significant cushion that we're observing. On the CLO side, majority of the holdings are in the BBB and BB space. About 47% of our holdings is in BBB rated corporate CLOs, about 53% in BB rated corporate CLOs. And I think this is a pretty powerful chart as we kind of discuss internally ourselves as well. If you just look at historical losses, this is a chart based on historical losses. In terms of the bars that you're seeing, the very peak, which was during the global financial crisis, the historical cum losses peaked out at around 6%. So just keep that in mind, that number specifically at 6% in terms of historical highs. This is during the GFC. And, relative to the credit enhancement level, which is the dark blue line, double, triple B credit enhancement levels, as well as double B credit enhancement levels. Triple Bs are around 12%, double Bs are around 8%. So losses didn't go up to these tranches on a historical basis. So keep that in mind about that 6% cum loss on a end this right here, and hand it back to Ken for questions and answer.
Sorry about all the dings. This is not our laptop. This is something we just borrowed, and it's been making a lot of noises, so apologize for that. Let's go through some questions here. So, okay, a Merry Christmas from one of you out there, and Merry Christmas to everybody, and Happy Holidays. Hope everyone, the families are safe. I know we got some COVID cases going up, but the flu has been pretty bad out here in Southern California. It's actually hit my family harder than even COVID. Lots of bonds to be issued down the road. Care to handicap the odds of monetization and financial repression to inflate the debt? We were talking about this today. The Fed's got a playbook. It's highly likely that they use the same playbook again, which is, buy bonds, suppress rates to keep the economy afloat. On the fiscal side, the government's got a playbook too, which is to spend money and give away money now. So there is a possibility that could be what happens if we go into a deeper downturn, that just lowering short-term rates can't help us get out of that. So what do you own in those instances? It's hard to say. Obviously, things like gold would do well in that environment. When some could argue that equities could also do okay in that environment. Obviously, you would think that would cause at some point rates to rise. They could suppress rates and do yield curve control. But now we're going into all sorts of hypotheticals, better over a cocktail somewhere one day. So I want to pass on going too far down the rabbit hole on that philosophical debate. The cash and DL income is in overnight money, so it's a little bit lower yield than T-bills, but it's about 3.7% and rising, obviously, with the Fed raising rates. We wanted to keep liquidity up a little bit. We do see tax loss selling across many of our funds, as everyone should be taking those tax losses, unfortunately. So we're keeping that in overnight funds that are earning about 3.7%, which you used to have to buy high yield at one point to get a 3.7% yield at the tights in high yield. Pretty amazing how much things have repriced. Technicals have been a big headwind for securitized assets, yes, this year. Do you think that's going to change? One of the reasons securitized have lagged is a lot of selling from the main owner of securitized credit is actively managed bond funds in the U.S. These bond funds and or separate accounts have been seeing outflows, partly due to the beginning of the year. I think people just wanted to get out of fixed income. And then towards the middle to end of the year, I think some of it's been tax loss selling, but there's also been a lot of people selling what they can sell in order to fund all the private fund investments that they went all in on that are all calling capital. And you're seeing this search for liquidity. And so I do think that as the calendar year turns, the tax loss selling slows down. You could see fund flows come back into bond funds. Issuance will be down for many parts of the securitized markets. So you'll have less supply, and all the net sellers could turn into net buyers if money comes back into the funds. And they don't come back into just one fund. They come back into all funds. The street doesn't inventory much these days. They'll sell what they own, and they'll all turn into net buyers to try to make money on the rebound too. So I think that the technicals could turn. There is a scenario where the technicals could be pretty positively skewed, especially early in the year. There is a January type effect. Someone asking about DBLIX versus DBL, one of our closed-end funds. I can't talk about DBL. There will be a separate webcast that will go through DBL, so I'll have to wait to answer that question later. I thought there was another question, but I can't see it online. I guess that was the last question. Sorry. I guess that was the last question. I was just looking on another computer to make sure. So thanks everyone for your support. Thanks for tuning in. Hopefully we wanted this time, we wanted to dive a little bit deeper into the different examples of what we own in the income fund. This has been a year of prices declining because rates went higher and spreads widened. We have not seen defaults, so the prices are down, but there's not defaults in it. As you can see, securitized markets is a loss-adjusted market, so we run all these bonds assuming a very high level of defaults to begin with, and then we can stress some of our securities even higher. Not all our securities are the same profile you see. Some are way less risk, some are a little bit more risk that may not hold up to the same increase in defaults, but obviously they will yield more than these assets. But a lot of what we own is in that kind of upper part of the below investment grade market, the double Bs, which do have a good amount of credit support, and we believe have a good risk-adjusted return profile. It's just been constant selling of the asset class, kind of a slow drip out of all these different funds and separate accounts, everyone kind of just being net sellers. So that's created a big relative value, I think, opportunity relative to corporates. We hope that we can generate some great returns on the future. I think we did okay this year, about down the same as the index roughly. Index is caught up a little bit ahead of us with a little bit of more duration than us, but I think the securitized credit's going to catch a bid here if risk assets hold up, and then you're going to play catch up out of the securitized space. So thanks again, and enjoy the holiday season.